Imagine standing in front of two identical doors that lead to your financial future, knowing that choosing the wrong one could cost you decades of lost freedom. You've heard the millionaires swear by real estate, while the tech moguls insist the stock market is the only path to true wealth. Yet the math they show you is almost always rigged to favor one side. It feels like everyone is selling a dream. But what if I told you that the secret isn't about picking the better asset, but about exploiting a hidden mechanism they conveniently leave out of the brochures? If you find yourself wondering which of these paths will actually let you retire early, hit that like button, subscribe, and drop a comment below, letting me know if you are team real estate or team stocks, because the answer might just change the way you look at your bank account forever. Most people look at the stock market and see a chaotic, spinning wheel of fortune where one bad headline can wipe out your savings in a single afternoon. They look at real estate and see security, a solid brick-and-mortar foundation that feels immune to the invisible volatility of digital trading screens. But here is the uncomfortable truth. Both sides rely on the same fundamental principle of compounding interest, yet they use completely different engines to get there. One engine runs on high-octane speed and accessibility, while the other is a slow-moving, powerful tank fueled by something called leverage. Let's look at the math, but not the kind you find in a textbook. I'm talking about the raw, gritty reality of how your dollar actually behaves in the real world. When you buy a stock, you are buying a tiny, microscopic slice of a massive, functioning machine that employs thousands of people and generates profit while you sleep. You don't have to fix a leaky faucet or chase down a tenant who is 3 weeks late on rent. It is pure, liquid growth, provided you have the stomach to watch those red and green candles dance daily. Real estate, however, is a completely different animal because it allows you to play the game with money you don't even have. This is the part that fascinates me the most. The bank is essentially handing you a massive loan to buy an asset that appreciates in value, while someone else pays down your debt every single month. It is the closest thing to a financial superpower that the average person can access, but it comes with a hidden tax that most new investors never see coming until it is far too late to turn back. Think about the sheer amount of time you are willing to trade for these returns, because this is where the emotional toll becomes heavy. Stocks offer you the ultimate luxury of time, allowing you to click a button and be done with it for 10 years, freeing your mind to focus on your family or your career. Real estate demands your presence, your effort, and your patience as you deal with broken water heaters and the unpredictable nature of local housing market. Is that extra effort worth the potential for higher returns? Or are you just buying yourself a second unpaid job? There is a psychological trap here that catches almost every beginner investor, and it has to do with how we perceive loss. When the stock market dips 10%, you see it instantly on your phone, and the panic sets in, forcing many people to sell at the absolute worst time. In real estate, when the market dips, you don't see a flashing red number on your screen, so you tend to hold on, effectively tricking yourself into weathering the storm. It turns out that your ability to manage your own emotions is far more important than the asset class. Now, let's talk about the silent killer of wealth that nobody likes to discuss: inflation and taxes. Stocks are taxed differently depending on how long you hold them, but real estate has these magical tax loopholes like depreciation and 1,031 exchanges that can theoretically allow you to grow your wealth almost entirely tax-free for a lifetime. But there is a catch. You can't exactly sell a bedroom in your house to pay for an emergency bill, can you? Liquidity is the price you pay for those tax benefits, and it is a price that could break you when the market turns. We have to consider the barrier to entry, which is the gatekeeper of your entire strategy. To start in the stock market, you need as little as $5 and an internet connection, allowing you to start compounding your wealth immediately. To start in real estate, you often need a significant down payment, a decent credit score, and the ability to qualify for debt, which can take years of saving just to get your foot in the door. Are you losing more money by waiting for a down payment than you would have made by just starting with stocks? Let's pivot to the concept of control, which is the primary reason why some people will never be satisfied with index funds. When you own a rental property, you have the power to renovate it, raise the rent, or change your strategy to increase your cash flow. In the stock market, you are a passenger on a bus driven by a CEO you will never meet and a board of directors you cannot influence. This leads us to a fascinating divide in the investing world. Do you prefer the safety of the herd or the risk of the driver's seat? Consider the compounding effect over a 30-year horizon, which is the only timeline that truly matters if you want to reach financial independence. If you put that same amount of money into a low-cost S&P 500 index fund versus a leveraged rental property, the real estate often wins on paper, but the stock market wins on consistency and ease of execution. Most people fail in real estate, not because the math is bad, but because they run out of liquidity or get exhausted by the management. Most people fail in stocks because they simply lack the discipline to stay invested. There is a shocking reality hidden in the historical data that completely shatters the myth that one is objectively better than the other. When you strip away the leverage in real estate and compare it to the volatility of stocks, the long-term returns are actually closer than you think, often converging toward the same historical average of roughly 7 to 10% annually. The real winner isn't the asset class itself, but the person who understands the tax code, manages their leverage responsibly, and refuses to let their emotions dictate their financial moves during the inevitable market cycles. But what if I told you that the most successful investors aren't picking one over the other, but are actually playing a game of transition? They begin by aggressively accumulating equities to build that initial liquidity buffer, and only once that safety net is established do they transition into the heavy lifting of real estate. It's like building a jet engine first to get off the ground, then switching to a powerful turbine once you are at cruising altitude. Are you trying to lift off too early, or are you staying grounded when you should be accelerating? Think about the compounding nature of debt in real estate. While debt in your personal life is a trap that keeps you awake at night, in the world of real estate, it is a tool. When you borrow money to buy an appreciating asset, you are effectively using the bank's capital to capture all of the upside while the tenant pays the interest. It is a brilliant, ruthless, and highly effective way to build net worth, provided you aren't over-leveraged to the point where a single vacancy or unexpected repair wipes out your monthly cash flow. Let's talk about the dreaded market crash scenarios, which keep most people awake at night. In the stock market, a crash is a visible, public event where your portfolio value drops right before your eyes. In real estate, a crash is slow, silent, and often hidden behind the fact that you don't have to sell your property if you don't want to. This is the ultimate psychological advantage of real estate: the ability to ignore the market's current price because your mortgage payment stays the same, unlike the volatility of a margin call in stocks. However, don't let that fool you into thinking real estate is safer. The lack of liquidity is a double-edged sword. If you have an emergency and you need to pull your capital out, you might be forced to sell at a fire sale price or deal with the months-long agony of closing a deal while interest rates are climbing. Stocks are at your fingertips. You can hit sell and have cash in your bank account in days. This accessibility is a massive advantage for someone just starting out who needs to keep their options open for career moves. We have to look at the hidden costs that nobody calculates. In stocks, the fees are usually so low they are almost invisible, provided you avoid the trap of actively managed mutual funds. In real estate, between the closing costs, property taxes, maintenance, insurance, and the occasional nightmare tenant, those thin margins can evaporate faster than a puddle in the desert heat. Are you really making 15% returns? Or is your net profit closer to 3% once you factor in all the time you spent managing the chaos of owning physical property? The conversation then shifts to the nature of risk itself. We often treat risk as a binary thing, but it is really a spectrum. Real estate risk is concentrated. You are betting on a single location, a single neighborhood, or even a single building. If the major employer in that town leaves, your investment could be toast. Stock market risk is diversified. When you buy an index fund, you are betting on the success of the entire economy. If one company fails, hundreds of others are there to pick up the slack and keep you moving forward. So, where does that leave you? The individual investor trying to bridge the gap between where you are today and where you want to be in 20 years. It means you need to stop looking for a winner and start looking for a strategy that fits your life. If you love the idea of building a legacy and enjoy the hands-on process, real estate will reward you with tax advantages and leverage that stocks simply cannot replicate. If you want freedom, mobility, and the ability to grow your wealth without adding stress to your daily life, stocks are your champion. It all comes down to the concept of the velocity of money. How fast can you get your capital into the game? And how fast can you make it start working for you? Stocks have high velocity. You start today, and you are working immediately. Real estate has lower velocity, but potentially higher impact over the long run. By the end of this journey, you realize that the best investors are not the ones with the most expensive degree or the most complex spreadsheets, but the ones who start early and never stop compounding. The ultimate insight is this: the gap between the middle class and the wealthy is not which asset they choose, but how they use their assets to create choices. Real estate gives you the choice to eventually stop working for money, while stocks give you the choice to never be trapped in one place. Both paths will eventually lead you to the same destination if you are disciplined enough to walk them. So the final question is, are you ready to stop listening to the noise and finally take control of your own financial destiny?